Here's something that will bother you for the rest of the week. Two people, same age, same net worth, same bill to pay. One of them hands the government $18,000 they didn't have to. The other pays nothing, zero. And both of them are completely legal. The difference isn't income, it isn't connections, it isn't even how much money they have. It's one phone call, one conversation, one strategy that's been sitting inside the U.S. tax code for over 100 years, and that your financial advisor has almost certainly never mentioned to you. This morning's data just confirmed that the average retiree selling appreciated stock to cover living expenses is quietly handing Washington somewhere between 20 and 37 cents on every dollar of gain. Not because they have to, because nobody told them they didn't have to. That ends today. B-roll, morning newspaper, coffee table, retirement account statement. Let me introduce you to someone. His name is Robert, 68 years old, lives in a paid-off ranch home in Mesa, Arizona, spent 36 years in regional sales, never made six figures consistently. But Robert was disciplined. He maxed his 401k every year. He bought Apple in 2003, Microsoft in 2009. He held through 2008, held through COVID, held through the 2022 sell-off, held through everything. And last February, Robert opened his Schwab statement and saw $1.24 million, a self-made millionaire, built from patience and nothing else. Now here's where it goes wrong. Robert's wife needs a knee replacement, $48,000 up front. The roof took a hit in the last monsoon, another $22,000. And their grandson just got into Arizona State. They want to help, call it $30,000. Total need, $100,000. So Robert does exactly what 60 years of financial conditioning told him to do. He picks up the phone, he calls his broker, and he says 7 words, sell 100 grand of the Apple. Now at this point, Robert feels good about himself. He feels responsible. He used his own money. He handled his own problems. What a prudent American. Except what Robert actually did, in legal, tax, real dollar terms, was voluntarily hand the United States Treasury approximately $18,000 he never had to pay. B-roll, calculator, tax forms, IRS letterhead. Here's what actually happened on that trade. Robert's cost basis on that Apple position, roughly $8,000. He bought it in 2003. That means he just realized a long-term capital gain of around $92,000. At his income level in 2026, he's in the 15% federal long-term capital gains bracket. That's $13,800 gone right there. Arizona adds a 2.5% state capital gains tax, another $2,300. But here's the part that makes this genuinely infuriating. Because Robert's modified adjusted gross income just spiked from that sale, his Medicare Part B premium for next year just triggered an IRMAA surcharge, the income-related monthly adjustment amount. That's roughly $2,100 more in healthcare costs he'll bleed out quietly over the following 12 months. And because his provisional income crossed a certain threshold, a larger portion of his Social Security benefit just became taxable at ordinary income rates. Robert wanted $100,000 in cash. To actually net that after taxes, he had to sell $118,000 in stock. That extra $18,000, money he earned, money he compounded for 20 years, money that at a historical 8% return would have been worth roughly $254,000 a decade from now. He didn't lose $18,000. He lost $250,000 in future growth to pay for a knee and a roof. Current market signals suggest that retirees are making this exact mistake millions of times per year, and not one of them was told there was another option. B-roll, side-by-side comparison graphic, portfolio chart. Now let me show you the other Robert. Same age, same net worth, same bill to pay. But this Robert doesn't call his broker. He calls his private banker, and he says 9 different words. Draw $100,000 against the pledged asset line. 48 hours later, $100,000 is in his checking account. He pays the surgeon, he pays the roofer, he writes the tuition check, he sells 0 shares of stock, he pays 0 in capital gains tax, he pays 0 in state tax. His Medicare premium doesn't move a penny. His Social Security taxation doesn't change. His portfolio stays fully invested, fully compounding, still growing at market rate. And he just spent the bank's money at an interest rate lower than what his portfolio is earning him. This is called buy, borrow, die. It's been hiding in plain sight since 1916. It's used by every major dynastic family in America, and the people you pay to manage your money will almost never bring it up on their own. B-roll, private wealth office, brokerage account dashboard, loan paperwork, standard educational disclaimer. What we're covering here is financial education, not personal tax or legal advice. Before implementing any of this, work with a fee-only fiduciary who specializes in high net worth retirement strategy, not the advisor inside your bank branch who's paid to sell you annuities, a real one. Clear? Good. The strategy has 3 phases. That's it. 3, phase 1, buy. You acquire appreciating assets, stocks, index funds, real estate, a private business, and you hold them. You do not sell. The IRS does not tax unrealized appreciation. Your $100,000 of Apple grows to $400,000 and Uncle Sam sees none of it. Nothing has been sold. Nothing has been realized. The gain is invisible to the tax code. That's not a loophole. That's the law. The realization principle has been the foundation of American tax policy since the Revenue Act of 1921. Phase 2. Borrow. When you need cash, you don't sell the asset. You pledge it as collateral and borrow against it. Banks will lend you 50% to 70% of the value of marketable securities. The interest rate is typically lower than a credit card. And here's the key. Debt is not income. The IRS cannot tax a loan because a loan must be repaid. That's been settled in over a century of tax case law. Phase 3. Die. This is the part that changes everything. When you pass away, your heirs inherit your portfolio, and under Internal Revenue Code Section 1014, the step-up in basis, the cost basis of every appreciated asset in your estate resets to the fair market value on the date of your death. Decades of phantom capital gains, erased, forgiven, wiped from the IRS ledger as if they never existed. Your heirs sell the stock. They pay essentially zero in capital gains tax. They use the proceeds to pay off whatever loan balance remains. They keep the rest. Generational wealth transferred. The federal government collects nothing on those gains. And in 2026, with the federal estate tax exemption sitting at $15 million per individual, $30 million for a married couple, the vast majority of upper-middle-class retirees owe nothing at the estate level either. 3 phases. That's the entire architecture. B-roll. Estate documents, family legacy graphic, probate office. Let me walk you through the mechanics of Phase 2 because this is where most people have questions. What we're seeing unfold right now is a broader awareness among everyday retirees that securities-backed lending, also called a pledged asset line or PAL, is available to them, not just to private wealth clients. Here's how it works in practice. You have a portfolio at Schwab, Fidelity, Merrill, Morgan Stanley, wherever. You contact the lending desk, not your normal trading rep, the lending team. You tell them you want to establish a pledged asset line. The underwriting is fast. Because your collateral is liquid and marketable, there are typically no closing costs, no appraisal fees, no application fees. They review your portfolio composition. Diversified blue-chip equities and broad index ETFs typically qualify for the most favorable advance rates, around 70%. Concentrated single stocks or volatile names get lower rates, sometimes 30% or less. Treasury bonds can get up to 95%. On a $1 million diversified portfolio, you'd typically qualify for a credit line somewhere between $500,000 and $700,000. You don't have to draw any of it. The line sits there, available whenever you need it, like a home equity line backed by your investments instead of your house. There are no monthly minimum payments unless you draw, no annual fee at most major firms. The line stays open as long as you maintain the collateral. In the current 2026 rate environment, with SOFR sitting around 4.3%, a typical PAL rate at a major brokerage runs between 5.5% and 7.5%, depending on the size of your relationship. Larger lines get better rates. Here's the math that matters. You borrow $100,000 at 6.5%. That's $6,500 per year in interest. Meanwhile, your $1 million portfolio, fully intact, fully invested, is generating somewhere between $70,000 and $90,000 per year in expected growth at historical market returns. You're spending the bank's money at 6.5% while your money grows at 8%. The spread is yours. That's the arbitrage. And the wealthy have been using debt exactly this way for centuries. B-roll, interest rate comparison graphic, portfolio growth chart, loan balance illustration. Now, I promised I'd be straight with you about the risks, because this strategy has real ones, and anyone who skips past them is doing you a disservice. Risk 1, the margin call. If your portfolio drops sharply in value, the bank can demand additional collateral or immediate loan repayment. If you can't cover it, they'll liquidate your positions at the worst possible time, at the bottom of a crash. This happened to leveraged investors in March 2020. It happened in 2022. It's real. The way experienced wealth managers handle this is with 3 hard rules. Never borrow more than 25 to 30% of your portfolio value, even if the bank approves you for 70%. Maintain a diversified collateral base built around broad index funds and quality bonds, not concentrated individual positions. And keep a separate cash reserve outside the portfolio, enough to cover 6 to 12 months of interest payments, so a temporary market decline never forces a liquidation. Follow those 3 rules and the margin call risk becomes genuinely manageable for most retirees. Ignore them and you've turned a wealth-building tool into a wealth-destroying one. Risk 2, interest rate exposure. SOFR can rise. Your 6.5% loan can become an 8% loan if the Fed moves. Model the strategy at higher rates and make sure it still works for you before you commit. Risk 3, behavioral discipline. Once you see a $600,000 line of credit sitting available, the temptation to use it for things you don't actually need is real. Discipline is the prerequisite for this strategy. The line exists for true cash needs, not lifestyle drift. B-roll, risk warning graphic, margin call concept illustration. Let me show you the numbers side by side. John, 66 years old, retired, $1.2 million brokerage account, original cost basis of $200,000. He needs $100,000 this year for a vehicle, a home repair, and a contribution to his daughter's wedding. He's in the 15% federal long-term capital gains bracket. His state adds another 5%. Scenario A, he sells. To net $100,000 after taxes, John has to sell approximately $118,000 of stock. The realized gain comes to around $98,000. Federal tax at 15%, $14,700. State tax at 5%, $4,900. Total tax bill, $19,600. His portfolio drops from $1.2 million to roughly $1.082 million. Over the next 10 years at 8% annual return, that balance grows to about $2.335 million. But he also lost the future compounding on that $19,600 tax payment, another $42,000 in forfeited growth over a decade. His true 10-year cost of selling, around $61,600. Scenario B, he borrows. John establishes a pledged asset line against his $1.2 million portfolio. He draws $100,000 at 6.5%, pays the wedding, the repair, the truck. Portfolio stays at $1.2 million, fully invested, fully compounding. Year 1, the portfolio grows by 8%. That's $96,000 in growth, minus $6,500 in loan interest. Net wealth gained in year 1, $89,500. Compare that to scenario A, where he gave up $19,600 just to access the same cash. The difference in year 1 alone is over $19,000 in preserved wealth. Over 10 years, the gap between the two scenarios expands to somewhere between $300,000 and $400,000 in preserved portfolio value. That's the cost of one phone call. B-roll, side-by-side scenario table, 10-year projection graphic. Now let's talk about the death phase, because this is where the strategy reaches its full power, and it's also the part most financial advisors are least comfortable discussing. Here's what we're seeing unfold right now in estate planning circles. IRC Section 1014 is arguably the most powerful wealth transfer mechanism in American tax law. Congress has tried to repeal it multiple times. The lobbying power protecting it has made it untouchable. When you die, every appreciated capital asset in your taxable estate has its cost basis reset to the fair market value on the date of death. 20, 30, 40 years of unrealized gains, gone, forgiven, as if the appreciation never happened. Let me show you what that looks like with John's numbers. John lives to 84, 18 years after retirement. His $1.2 million portfolio has grown to roughly $4.5 million. Over the years, he drew a total of $500,000 against his pledged asset line for living expenses. That loan balance is outstanding at his death. Without the step-up, his heirs face an unrealized gain of roughly $4.3 million. At 20% federal long-term capital gains plus the 3.8% net investment income tax plus state, the tax bill could easily exceed $1 million. With the step-up, the cost basis resets to $4.5 million on the day of death. His heirs sell the portfolio. The realized capital gain is essentially zero. They pay essentially nothing in capital gains tax. They use $500,000 of the proceeds to retire the outstanding PAL balance. They keep $4 million. The $500,000 John spent during retirement, funded by the loan, was effectively spent tax-free. The interest he paid on that loan over 2 decades? Call it $300,000 in cumulative interest depending on rate path. That was the cost of admission. By comparison, if John had sold $500,000 of stock over the years to fund the same lifestyle, he would have triggered somewhere between $100,000 and $125,000 in realized capital gains tax, plus the loss of compound growth on every dollar sold, which over 20 years could easily represent another $1 million or more in forfeited portfolio value. The borrow strategy doesn't just defer taxes. In coordination with the step-up at death, it eliminates them permanently. B-roll, estate transfer graphic, IRC, Section 1014 reference inheritance illustration. Here's your action plan. 6 steps, plain and simple. Step 1, pull up your taxable brokerage account today and note your unrealized gains. The larger your embedded capital gains relative to your cost basis, the more powerful this strategy becomes for you. If you've held appreciated positions for years and your cost basis is low, the PAL strategy is potentially significant for your estate. Step 2. Call your custodian's lending desk, not your trading rep, the lending team. Schwab has this product. Fidelity has it. Merrill has it. Morgan Stanley has it. Ask for the rate sheet, the advance rates by asset class, and the maintenance margin requirements. Get the paperwork. Step 3. Establish the line before you need it. The worst time to apply for a PAL is during a market correction when your collateral has dropped in value and your need is urgent. Set it up during calm markets. Let it sit. Treat it as a financial fire extinguisher. Available when you need it, untouched when you don't. Step 4. Set personal borrowing rules before you draw a single dollar. Borrow no more than 25% of your portfolio value. Reserve the line for genuine cash needs. Keep a separate cash buffer to cover interest payments in down markets. Step 5. Work with a fee-only fiduciary CFP who understands this framework. The PAL is one component. The full buy, borrow, die strategy works best when it's coordinated with your trust documents, your beneficiary designations, and your overall estate structure. Get professional guidance before implementing. Step 6. Do not gift highly appreciated assets to your children while you're alive. If you gift appreciated stock during your lifetime, they inherit your low-cost basis, not the step-up. The step-up only happens at death. Counterintuitive as it feels, holding appreciated assets until death is mathematically superior in the vast majority of cases for taxable brokerage accounts. B-roll, checklist graphic, estate planner consultation, calendar with timeline. Here's the bottom line. Current market signals suggest that most American retirees are still operating from a financial playbook written in the 1970s for a tax environment that no longer exists. Work hard. Save in a 401k. Sell what you need in retirement. It made sense then. Today, it's quietly costing ordinary families hundreds of thousands of dollars per decade. The framework we've walked through today, buy, borrow, die, is not a loophole. It's not a trick. It's the explicit, codified architecture of the United States tax system, built to reward capital ownership and available to anyone disciplined enough to use it correctly. Your portfolio is not just a savings account, it's collateral, it's a tax management tool, it's a generational transfer mechanism. The step up in basis at death is one of the most powerful financial benefits available to any American investor, and it belongs to everyone, not just the ultra-wealthy. You earned every dollar in that account. Don't volunteer a quarter of it to Washington because nobody told you there was a better way. Now you know there is. What we're seeing unfold right now is a shift. More retirees are asking these questions. More advisors are being held accountable for not having this conversation. If your advisor has never mentioned pledged asset lines, IRC Section 1014, or the step-up in basis in the context of your retirement plan, bring it up at your next meeting. Watch the reaction. Ask why it was never discussed. You earned that conversation. Drop a comment below. Have you ever paid capital gains tax on a stock sale specifically because you needed cash? Did your advisor offer you a better option first? Let's hear it.